So Jason talked about micro. He talked about micro cap. And because we are a full service investment firm, we thought it was only fair to have, and this is a political season, we thought it'd be fair to give equal time to macro. So now for the next hour or so, we're going to focus on macro, but it's going to be the macro economy. And we're going to have, in a few minutes, Jim Bianco, our featured speaker, will come up and talk to you about what he sees in the economy. But I thought it might be interesting to take a few minutes to give you a bit of a perspective on the investment markets, especially how have things really looked over the last year. So about exactly a year ago, I was standing here and we were talking about the third quarter of 2013, and now here 12 months later, look at what has happened in the investment markets. So if we look at one-year returns in the S&P 500, almost 20%. The next biggest return was 13+% from the U.S. real estate investment trust market. Now, those of you who are clients know that we look at the investment world consisting of three basic risk categories: the higher risk, the medium risk, and the lower risk. Well, large cap and REITs are higher risk, but some of the other higher risk assets did not do as well. The EAFE, which is the measure of the developed world, the developed world outside the U.S., only achieved a return of 4.7%. Now, part of it's a bit misleading because if you take out the impact of U.S. currency, it was actually over 11% in local currency terms. So there were double-digit returns. The emerging markets were also, if you were a dollar investor, under 4%. How did the hedge fund universe do? Well, the hedge fund composite index was right around 6% for the last year, and that's what we would expect. We view that as a medium risk investment with characteristics of both stocks and bonds, and we would expect returns to fall within the stock and bond mix as well. The lowest risk asset class, municipal bonds, taxable bonds, both came in at about a 4% return over the last 12 months. So where are the outliers? Well, we see down at the bottom, small cap stocks, only 4%, property and REITs outside the U.S., only 1%, and commodities, which generally will only do well if there's inflation. We've had none. Commodities have trailed. What if we take a little bit of a longer look and look at the 10-year returns, going back to October of 2004 through September 30th of 2014? We see a little bit more of what I would view as a typical pattern, and that is to say the higher risk assets, with the exception of commodities, all appear to have given the highest return. Emerging markets, went one too far. 10-year returns of 11%, and about U.S. REITs 8%, and so on and so forth. So the major risk categories gave, in fact, the returns you would have expected. Although, look at international, look at that EAFA index. It's a little bit lower than we thought, 7%. We would have expected it to be a little bit higher. Was the dollar the culprit over 10 years? No. In fact, if you were a local currency investor outside the U.S., you had a return of about 6% in local currency. So clearly, the non-U.S. developed world did not do as well as over the last 10 years. Another disappointment were the hedged investments. They also trailed the bonds. They were only 3.4%. So what does this tell us about what's happened, and more importantly, how can we take a look forward about some implications for the future? Jim is going to address the issue of quantitative easing, but I thought it'd be important to take a look and see just exactly what the Federal Reserve has done since 2008. And of course, quantitative easing refers to the bond buying program, Federal Reserve buying treasuries, buying mortgages, and they did it to the tune of $85 billion most recently. There were actually 3 iterations of QE. The first one started in 2008 in December and went to March of 2010. During that time, the S&P rose 35%. And then they stopped QE, and the S&P fell 12%. So then they did quantitative easing number 2 from November of 2010 to June of 2011, and the S&P went up again 10%, and then they stopped and it fell 14%. So then at the end of 2013, they did QE3, or as some people say, QE infinity. They said, we're going to keep spending $85 billion a month. We're going to buy up treasuries. We're going to buy up mortgages until the unemployment rate gets under 6.5%, until the economy starts growing. And we have now, today, the highest reading on the S&P in history, about 2032. We had a little blip in October, you might remember. October is always a bad month for stocks if you look at history. But we recovered. Turned out not everybody was going to get Ebola, and the world was going to remain safe. So we're back up to the highs. And now the question is, because as of last Friday, a Halloween, we hope it's a Halloween treat and not a trick, the Fed stopped buying bonds. And they said, we are going to, in effect, see if this economy can continue on its own. And we're through. We're done. We're not going to do anything, as I say. Just like they said the last time, right? So interestingly enough, remember the dollar, the currency that you love to beat up, and, you know, to paraphrase Winston Churchill, the worst currency in the world except for all the others? Well, the dollar has gained about 8% against a basket of major currencies in the third quarter. It's up about 13% over the last 3.5 years. So again, to quote Mark Twain, the results of the dollar's death have been greatly exaggerated. What does this mean? We have a strong dollar. Strong dollar means that imports go down. So the BMWs are cost less. The Lexuses cost less. Foreign goods cost less. But our exporters are going to pay more. That is to say, their customers will pay more. American goods will cost more. A weaker currency, like the yen, like the euro, weaker currency pushes up the cost of imports, and that also helps a country's exporters, and frankly, it helps reflate the economy. So when you hear about a country that is sort of deflating or actually trying to inflate their economy, they will try and weaken their currency, and you're seeing that right now. We had a big surprise over the weekend with Japan. Their central bank head, Governor Kuroda, he sort of doubled down on quantitative easing, and this little cartoon says that the baton should be passing now from Dr. Janet Yellen, the Federal Reserve Chairman, to Mario Draghi, who heads the Central Bank of Europe, the European Central Bank. And here in the little cartoon, Dr. Yellen is showing Mario how to print money, how to use the money printing machine. Now, those of you who are especially astute at small little things will see the picture in the background. Do you recognize that gentleman? Anybody recognize? Ben Bernanke. Ben Bernanke, yes, but do you see his name? And by the way, you have copies of your slides in your materials, but it says Edward Quince. Edward Quince. So you may not know it, but during the depths of the 2008 recession, when things looked really bad, things were so bad that Bernanke was communicating with his colleagues under the pseudonym of Edward Quince. So, well, passing the baton to Mr. Draghi, the pressure is on Europe. Why? What's going on in Europe? Well, they have no inflation. Actually, you can see the curve there. The Eurozone inflation is actually disinflating. They're getting close to worrying about the big D word, deflation. The economy is not growing at all. The projection for GDP growth is barely positive for 2014. Why do we care about that? Well, because Europe is a big economy, $17 trillion. It's 17% of the world's GDP. So if Europe is down, that is not good for the rest of the world. So the pressure is on for Mr. Draghi to repeat the lessons that the Japanese central bank has done, the Federal Reserve. Now, Jim's going to talk about whether or not that's been successful, but we do know in the U.S. it's certainly been successful in raising the stock market. So I want to talk about one investment implication that we at Altair see of this situation outside the U.S. Again, the U.S. is certainly not a strong economy, but again, relative to everybody else, we've had a pretty decent recovery, albeit one that is way below the norm that we would expect to come back from recession. Take a look at this chart, which shows 4 European companies that are among the best global multinationals in their industry, and see what they're selling at compared to their American counterparts. So the famous German company Daimler, makers of Mercedes, right now that company is selling at a price-earnings ratio of 8.5 versus GM, which needed the federal government to bail it out. They're having 1 or 2 problems with their airbags and a few other things, ignition switches, but they're selling at a PE of 23. Total SA, which is a French company, it's one of the 6 super major oil and gas companies. They're selling at only 10 times multiple versus ExxonMobil, which is also one of the world's largest oil companies. How about HSBC, Hong Kong Shanghai Bank? They're headquartered in the United Kingdom. They're the 2nd largest bank in the world. JP Morgan Chase, they're the 6th largest. Well, right now HSBC, a bargain at 12 times earnings versus 15.3. And finally, GlaxoSmithKline, the 6th largest pharma company in the world. Merck is the 7th, but its price-earnings ratio is almost double. So you know that our advice centers on looking at your overall asset allocation of higher risk, medium risk, and lower risk assets. And at times we may overweight a particular risk category. The last time we actually went to a full weighting was when the Federal Reserve went to a QE3, a QE infinity. But right now, and for some time, we've been at a neutral weighting. So that says that for our clients, their risk tolerance is paramount. We want them to be at their long-term asset allocation between high, medium, and low-risk assets. But we are recommending a change within the high-risk category, and we've begun suggesting an overweight to non-U.S. stocks, a small overweight by around 10%, and trimming correspondingly from overweight positions, especially in the U.S. large-cap market, which has done so well. Now, it's for 2 reasons. It's a belief on this undervaluation that we're seeing now relative to also this central bank activity that we think will spur the markets. But we do feel that long-term international stocks should certainly give you the types of returns that we can expect from the U.S. as well. Now, on that note, let's take a somewhat deeper dive into the macro pool and look at some issues of the day with our guest speaker, Jim Bianco. Let me tell you a little bit about Jim. You know, every year at Altair, when we talk about planning for the forum and we think about who can provide